Maverick traders, welcome out to your market roundup for February 21st. Nice to be with you. Corey here with you. Let's get to it. So as we look at market analysis and look at what's happening in the markets, a big tumble today. Most markets down around 2%. You can see the Russell 2000 small caps even approaching 3% losses on the day. Oil and gold relatively flat. Which is pretty good in today's bloodbath. As we think about the markets, advancers versus decliners, we almost had one of those 90%er days, and those are particularly bad where they kind of signal widespread selling, and we almost hit that, which is kind of a sign that either today was a breakdown or an exhaustion. And I think in the short term, it was an exhaustion. On an intermediate basis, I think we've got more to go. On the 50-period moving average, about half and half. Still a few more stocks above the 50 MA than below, but we've certainly reversed trend since a couple of Thursdays ago. We talked about watching for that big exhaustion move, and when it gave us that exclamation point that we wanted to de-risk and stop being bullish, and boy was that. It happened to be the top, which is sort of lucky. On the daily news, markets fell lower. Really, rates are a bit of a concern. Rates have been spiking of late. We're still in this inverted yield curve where the 2-year yield is well above that of a 10-year yield. And when it sustains like this, it's a signal of basically that something is out of whack, that something is out of place. It's sort of like what happens in the futures markets when you get into backwardation. Oil prices or commodities should be priced so that a commodity would be more expensive out in time than it is today, right? We would anticipate the prices go up. When they're backwardated, that gets backwards, and it kind of speaks to something abnormal happening in that particular market. Well, that's what's happening in the yield markets. 2-year yield well above that of 10-year, saying, hey, we've got some short-term risks, and people are hiding out in short-term bonds accordingly. So still speaks to a nervous market. Let's review where the S&P has been and where we think it's going. So first of all, we talked about this over and over again in these Tuesday market roundups, right? This is the way that I saw it, which is Elliott wave. We went through a big 5-wave bear market. We initially rallied up and had a nice exhaustion. See this huge bullish candle, kind of a signal that, hey, this run is done. That was the top of the A. Then we fell back in price and people got out of their minds bearish. We talked about put to call ratios hitting a new all-time high. People loaded up on puts. That set the bottom there. And from there, I was quite bullish on the markets. I really expected a strong advance. I talked about it a lot that we should break above the downtrend line. That would create max pain, that we should have a nice acceleration, and most people were certainly quite bearish, as talked about with the put to call ratio. When they load up on puts in December, they were loading up on the front 2 months, on January and February. Well, we just so happened to pass February 17th last weekend. That's the monthly expiration. All those puts that were bought in December wiped out of the money, etc. And this is where I said markets could get a bit more dicey because now they're unhedged, unprotected. And sure enough, there was some selling pressure today. We saw the VIX spike. They're coming back after some insurance, some protection. I think that's a short-term dynamic where we're probably hitting a little mini exhaustion bottom. I would anticipate that maybe we gap a little lower and then rebound, and we actually see a bit of a rebound for a few days or a week or so. But I don't think the market's out of the woods yet. I do ultimately think we're going to go down and test some lower prices. But in the short term, if you're strategic, I think we got a little bit of a bounce coming in the next day or two. The NASDAQ, like we talked about, really was, to me, I was traveling with my family in Puerto Rico, but I had talked about it. Watch for an exclamation point. Watch for an exhaustion. Watch for the markets to spike sharply higher, gap up in the air, and just kind of leave this big emphasis, right? This big exclamation point, so to speak, as to the upside. And it happened there, and we've basically been down almost every day since. Well, we essentially have been down since then. That was the peak. And again, I think we're hitting a little bit of a mini exhaustion. I personally don't think it's just bon voyage to the downside. I'm not too worried about the market's just collapsing in the near term. I think it's just still in a little bit of choppiness, and we want to use the next bounce, just like we've been using prior bounces, to re-engage, reinitiate shorts, get more bearish. I don't think this is a market you have to chase. In other words, you'll get some opportunities, but today was obviously hugely down, and this is why it's a profit taker. This is why I call it an exhaustion. If you've been short as you were buying puts or being bearish or so forth, if you thought that the markets had topped out a few weeks ago with that big exhaustion high, that exclamation point, so to speak, and if you had bearish positions, today would be the day where they look the best, where you're kind of like, this is why I had this bearish position. If you had a bearish position on name the stock, it was probably down quite sharply today. And today is your opportunity to kind of lock in profits, or first thing tomorrow. This is, to me, where I would certainly consider profit taking on the bearish positions. And that's a little counterintuitive. Here is where people make huge mistakes, is that now they're getting bearish. They're finally like chasing the market. They finally realize that the market could go down or is going down or whatever. And you just have to be ahead of the curve. You have to have initiated bearish positions previously in lighter volatility periods when the setups were better, and then use days like this to lock in those profits. So if you found yourself without bears and chasing the market lower and so on today, you're sort of backwards to how it should be and how you need to be, I think, to be successful. So a lot of red out there. Could it be a breakdown where it kind of picks up some speed? Sure, it could be, but I don't think statistically that's likely. Where again, when you get a big flush like this, but you're still above your 50-day moving average on the S&P, that doesn't speak to a runaway bearish trend in the short term. It speaks to, hey, we're getting hit hard, within reason. We want to take profits because you'll probably get this next bounce back, as people still say, oh, it's okay, we're still above the 50 and so on and so forth. So I hope that makes sense. Uh, as far as the heat map, a little bit more green in energy, certainly, a little bit more green in consumer defensives. I thought it was interesting that Walmart turned green. Walmart had some pretty lackluster news today, and yet it turned green. Remember the old bad news, good price action? That's a market tell. You certainly got to look at Walmart and say, okay, is this something that I can buy for a trade? Weekly, monthly outlook. Again, I've kind of considered myself more bearish to neutral, is what I call it. I'm expecting a push down, but expecting a choppy trade overall for now. Where do we pick up steam? We should pick up intensity on the downside at lower levels. So if I was looking at it, probably bounce and do some of this or whatever. When you want to be more aggressively bearish would actually be down here more in the later period here. We're still above a 50 MA. We're still kind of grinding higher. So we're not there yet. We're kind of in that topping out process. It should. Tops are usually more rounded, right? Whereas bottoms are V-shaped, V-shaped, V-shaped type of bottoms. Tops are often more of a rounding pattern, more of like, head and shoulders tops and things like that. More of kind of a rounding approach to it. So that's pretty commonplace in terms of price action. Let's talk about trades. You'll notice something, a lot of times I like to identify a sector that I feel the most conviction in. And right now, what looks best to me for buying is in the financial sector. So I'm looking at the big money center banks, and I've kind of highlighted 4 financials here as kind of an area of focus. And then I also have an international stock here. We talked about Tesla. We introduced that last week on the neutral side, and Tesla is almost exactly flat from last week. So far so good on that. And then on the bearish side, just a a mix of different sectors and groups, just a couple of charts that maybe caught my eye. But let's really focus in on financials and what we're seeing here. So ultimately, it's choppy, it's sideways, but it's triggering something. I don't have the Bollinger Bands on here, but it's actually hitting the lower Bollinger Band. You'd have Bollinger Bands that kind of go like this. And here's your 20-period moving average. It's 2 standard deviations below the average. In other words, it is oversold, but still above the 50-period moving average. We had a recent crossover. Do I trust the moving averages a lot? Nah, I mean, they're pretty sideways. I'm not putting a lot of emphasis on that, but I think it should be set up for a bounce. Look at Citi. Similar dynamic, probably even a little cleaner chart, a little bit more bullish perhaps. Above a rising 50, down there towards the lower Bollinger Bands, that sort of idea. And not just that, you kind of have little corrective patterns, little what we call bull flags and those types of things in the financial sector. A lot of stocks, a lot of sectors are now giving up their 50-period moving averages, and most of these financials are well above them. Even the XLF, the financial sector ETF, still above its 50, acting better than most sectors. I think this is an area to consider buys in the next couple of days. And oh, by the way, higher interest rates in many cases helps them because now they're able to sell loans and charge more interest and so on. So it should be a good environment fundamentally where things should be shifting. Now, if we don't, you could say, well, what if we go into a massive recession and then they lose on that side? That's true. If the economy collapses, then financials have a lot of risk to lower asset prices and so on. But what if interest rates are just higher for longer, but the economy keeps chugging along, which is actually where the data is right now? That the Fed's still raising rates, but the economy's hanging in there. Unemployment is at new all-time lows, et cetera, et cetera. So should be a good environment in here. MELI has pulled back to the prior breakout zone. Again, kind of a little corrective flag type of pattern. I would anticipate a move up and out from here is more likely than not. On the bearish side, as we said, just a few different ideas and names. Here's General Dynamics. This is an area defense stocks look like things that are heavy that may want to trade lower, and GD has kind of an interesting setup today. Gapped up, but then couldn't hold those gains and came back in. Again, hitting an upper Bollinger Band. I don't have it on here, but this one's the opposite. Hitting the upper band, so it's overbought, but still below a declining 50 MA. So overbought in a downtrend equals, in many cases, lower prices are coming. Vale, this is a stock that has broken below the moving averages and now retesting from underneath. Big bearish candle there. Long upper shadows like this are often peaks that then proceed to trade lower. So this one you've got to be a little bit careful with. It's an international stock again. An ADR, an American Depository Receipt, that causes more gaps in the chart. But if you wanted to trade some sort of bearish spread, could be a consideration. And then last but not least, we have WM. And looking at this, again, just kind of a break of the prior levels, retesting from underneath. It's kind of choppy in here, but at the upper end of the range. Should kind of work its way back towards 50. And as it starts to break down, I'd probably be taking profits at that area. So markets have really played out this full 5-wave down, big ABC correction, and now it's starting to stall out. I think a bounce is coming here, but we're still in a bear market, and even as we rallied earlier this year, it was my opinion that we're still in a long-term secular bear market, even though we had a good, strong short-term uptrend. That uptrend was more of an ABC correction, not the beginnings of a new bull market, in my view. FOMC minutes on Wednesday, preliminary GDP on Thursday, and then a lot of earnings. We've got Apache, we've got AMT, that's a American Tower, Alibaba, Berkshire, which reports over the weekend. MELI. Now, I want to highlight this one because it was in our bull list. If you're going to trade it, make sure you understand you're going to trade it through earnings. I do not have a position yet, but that could change. Moderna and Newmont Mining. So we've got gold miners, we've got some tech, Nvidia, Palo Alto's reporting tonight, coming out right now as I record this. Rio, Square, um, letter U, VMware. I'm trying to remember what U is. They're kind of that AI, that competitor with Roblox and such. So anyway, a lot of companies reporting earnings there. That there's still some volatility, but we're getting towards the back end of earnings, and it hasn't really done much to push the markets sharply higher or sharply lower. It's been more about the Fed, more about the economy anyway. So hope you've enjoyed the market roundup. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.